Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Rieder is BlackRock's CIO of Global Fixed Income and is widely considered to be one of 5 contenders to replace Fed Chair Jay Powell. He writes the following: moving interest rates lower is very much in line with what we do know today, which is that the labour market is clearly slowing to the point of potential stall speed. Rick joins us now for more. Rick, good morning.
Thanks for having me.
Good to see you, my friend. It's been too long.
Thank you.
Welcome to the studio. Have we got a labour market problem?
I do. And by the way, I don't think it's a cyclical phenomenon. I think there is, for the way Lisa was, I think we have a productivity revolution that is pretty extraordinary. People point to AI as an exclusive driver of that. If you look across what companies are doing, including second quarter earnings, third quarter earnings, if you look at the dynamic around how you think about logistics, freight management, predictive maintenance, customer procurement, companies are doing more with less, and I think that is a secular dynamic that's going to be with us for a couple of years now. I mean, we can talk about there's a bit of elevated inflation because of tariffs, but I think we're going to be dealing with something. By the way, you also put robotics, automation. This to me is a structural dynamic. I think full employment will be the challenge for the next couple of years.
So we mentioned the spread between earnings growth, fantastic, employment growth, terrible. How are we closing that gap, if ever?
So I think, by the way, I actually think that's not a coincidence. Those aren't coincident factors. What's happening is companies literally, the top line revenue is pretty good generally, but what's happening is they're cutting costs of goods sold, they're cutting their SG&A costs, they're reducing their cost infrastructure. By the way, AI is a technology. There's historically been this dynamic of when you have new technology, it moves people into other higher value jobs. This technology, by the way, I put robotics and automation on top of it, autonomous driving, et cetera, is literally designed to replace human input. You have a dynamic that is pretty extraordinary that I think, if, as a central banker or whatever, as you think about being anticipatory of where the world is going, that is where the world is going, and I think that is a challenge. The economy's doing fine, divergent, and quite frankly, only operating on a couple of cylinders. Huge CapEx, which we talk about from cloud, from infrastructure, from power, and you've got higher income, wealthy savers that are doing great and supporting consumption in the economy. And then you have the part of the economy that's interest rate sensitive, that's really struggling. And that's part of why the interest rate tool needs to address low income, small business, housing. And that's where I think you square the circle.
So we've got to talk about this from two perspectives. One as a policymaker, the other as an investor, and one, of course, informs the other. Let's just sit on policy for a moment. You're talking about maybe the need to cut interest rates, but also the fact that some of the pullback we've seen in hiring is not cyclical. How can we address one with lower interest rates? Just explore that for us a little bit more.
Yeah, so first of all, if you came down from Mars and said, okay, so I've got 5-year inflation break-evens that trade in the market, you buy as many as you want at 2.35%. And you said, okay, now set the price. And you said, okay, 2.35% inflation, and I clearly have a slowing labor market. You would say, gosh, I don't know, if I set the rate at 3, and then I thought about, okay, so now what's equilibrium on the mortgage rate to create velocity in housing? And it directly related to what you said. Housing today is 3/4 of the wealth by people in the country is in housing. We have a housing market that, you look at the earnings from D.R. Horton, you look at Lennar. By the way, I just saw an ISI home builder survey that showed the softness. If you actually get the mortgage rate down a bit, then what happens is all of a sudden you get housing velocity. Why is housing velocity important? Because you get labor mobility. Today you can't move. You lose your job, you got to go somewhere else, you can't move. Secondly, and I've said it before, for every home built in this country, we hire 3.1 people. It's pretty hard to AI building a house. So if you can get some real estate velocity, and by the way, it's why young people who are struggling today, young people who aren't savers, who are borrowers, that's the way they build wealth. That's the way you put people to work. And so I think it is all a related concept. Point being is, and by the way, I mean, if we had to raise interest rates to where they were, But if you said to me today, what's equilibrium, I don't think it's where we sit today in the funds rate.
So how willing are you to allow, or how willing would you be to allow inflation to run above that 2% target in order to run the economy hot to allow for more job creation?
Listen, that's a great question. And I think every time you think about these things, and I think about the same thing, we take risk. You sort of think about what are the quadrants of risk? What are you willing to underwrite? So today, when I think about those quadrants, if you were willing to take some labor and some overall inflation, then you think about, okay, what are the sticky drivers of inflation today? Healthcare, education, insurance. It's pretty hard to use the interest rate tool to get insurance costs down. It's pretty hard to get a healthcare. So the tool is not that robust. And health shelter is a sticky part of inflation. That, if I actually get the rate down, I'll actually mitigate some of that elevated. I'll mitigate the rental inflation. So, I'll throw one other thing. 5-year inflation expectations are 2.35%. If you were at 2 3/4, and by the way, core PCE, the 6-month moving average core PCE is 2.5. Let's say we're probably closer to 3 if you take the whole full construct of inflation. 3 is not an infectious. You clearly don't see it in terms of where people anticipate inflation. If you're running 4 or 5, then I'd say, gosh. Or if the 3 was trending higher on things that the interest rate tool impacted, then I think you'd have to address that.
Just to sort of build on that, this idea that 3 is okay, but above that, maybe not so much. There's a feeler that there is an asymmetry in the time frame of AI. That right now the build out is going to be inflationary because of the inflationary inputs of commodity costs, of just how much lending and money this is generating on a broad scale. The productivity gains that will cause disinflation will take a lot longer to come into play. So how, if you were the head of the Fed, would you handle that?
So I take a couple of things. So think about historically the way the interest rate tool worked is it was a modulator of capex. So you think about, go back 60s and 70s, the big spenders in manufacturing. Today, my guess is OpenAI, NVIDIA, Google, et cetera, it's not the interest rate tool that is affecting capex. They are going to put that capex in because there is a long run benefit for doing it, meaning the interest rate tool doesn't really do a lot. So I think at the end of the day, does that create a little bit of inflation in the areas you described? I think so, but I think you have to say, where are we going? And I always say, being an investor for a long time, the concept of data dependence, if you were constantly in the rearview mirror trying to figure out how would you invest, is probably the wrong way to do it. We are going through something that's very different. We now are in a capex cycle. And then if you break down the economy and say, okay, what is driving GDP today? That's what's driving this capex and some consumption from higher income people.
The key piece of the inflation story is shelter. You touched on it. And you said something interesting. Interest rates down, shelter costs down. Just explain that for us.
Yeah, so we have an inventory problem in the country. And by the way, look at every piece of data. It shows the same thing. And so, by the way, when the mortgage rate has come down a bit post this recent Fed drop in interest rates, all of a sudden you're seeing existing home sales pick up. We just saw the prepayment report for mortgages, and all of a sudden you're seeing some acceleration. Meaning you don't have to get the interest rate tool down that much. If you got the mortgage rate into the 5s, I'd say mid to high 5s, you would see some velocity of housing. If you saw velocity of housing today, I saw on D.R. Horton's numbers, they talked about they're doing 1% first year mortgage, and then I think it's 4.9 because they've got to subsidize the mortgage. Well, what if D.R. Horton didn't have to do that? And what if organically the rate was lower? They'd build more houses, you'd create more inventory. You create more inventory, you take the pressure off of rental rates, and you start to bring inflation down. Plus the labor mobility, that is not an insignificant part of that.
Do you think the Fed needs to think outside of the box beyond just interest rates? Is there something else we can do here?
Yeah, I think the Fed has a series of tools. The interest rate tool, by the way, today, nobody really borrows off the overnight funding rate. The interest rate tool, it used to be, you think about how banks borrowed short, they lent long, we had a very different dynamic. Today, the way we tranche the debt in the economy, think about how we finance resi, commercial, asset-backed credit cards, auto loans, it's tranched. The front end of the yield curve doesn't really do a lot. How you think about, where is the 10-year point? How do you think about your balance sheet? How do you think about all the other tools that are at your disposal? I think are really important. Plus, you got to think about what is the effect of the currency, et cetera, relative to that. So anyway, I think the construct is much more complex and much more, quite frankly, you have a lot of tools that create much more effectiveness, and we're just going to move the overnight funds rate every 6 weeks.
Like the balance sheet. How much would you be open to see the Fed use the balance sheet a little bit more?
So I think the construct of the balance sheet is important. So I think people don't realize there's a notional dynamic and there's a DV01, there's a duration dynamic further out the yield curve. I am sympathetic to should we keep the balance sheet around the same level, but you could be really effective. So today, the U.S. Treasury, 89% of what the U.S. Treasury finances is at the 0 to 2 year point. 89%. Think about if you're a company, would you ever finance in the 1 year? Like it's crazy. But that's where we are today, and it is what it is. So there's not that much float actually longer on the curve. There's a reason why people put on steepeners and they get squeezed out of steepeners, because there's not that much float. You don't have to use that much balance sheet. But if you thought about, gosh, the construct of the balance sheet, if we used more of it further out the curve, we let runoff happen on the front. If you can keep the stability of the back end, so if you can keep the 10-year, we got to the 10-year was 390. If the 10-year was 3.5 to 4, stable, and rate volatility came down, all of a sudden you'd see mortgage spreads could come in, then you'd get, and by the way, deregulation of the banking system, then you get mortgage velocity moving. So, by the way, I don't think we're that far away. And by the way, this concept of, we have to get the rate down hundreds of basis points, I just think we're not that far away. Just get it there, keep volatility of the rate market at a stable level, and then you'll see a system that'll operate pretty well.
Rick, you've seen a lot, going back to the late 80s. How much fun are you having right now?
I've said before, this is the best investment environment I've ever seen. Not because stocks are going to go straight up. You have divergence that is great for investing. You have technology that's changing, and so the ability to look at tech stocks, healthcare tech, to look at, where some of the financials, how you create velocity in the system. And then, the earlier conversation, we were talking about the break. Like now, the income levels, as long as this interest rate stays here, which, what's ironic is commercially, I'd prefer the interest rate to stay here because this is pretty good. We can create portfolios. We run this ETF called BINC. And, creating 6.25, we're running almost 630 now. You don't have to take a lot of risk. You don't have to go out the yield curve. That's pretty good. So anyway, I think, and by the way, the options market, I think the best opportunities are in the options market. Rate options, equity options, and you could manage your convexity. So you can be long equities and then buy a lot of, you can overwrite your single name stocks, you can buy downside. It's a fun environment.
Well, let's lean into BINC. You mentioned it, the iShares Flexible Active Income ETF. What kind of things have you been doing over the past 16 months?
We've been, the cool thing about being active is you can move around because the regime shifts. And while, I was describing earlier, like, where do you think the interest rate should be? The truth is the interest rate isn't going to move very far. So, we're keeping our interest rate duration, in and around 4 years. We've moved a little bit out of the very front end because it's pricing a lot now in terms of where this Fed is going to go. Then we've shifted some of our credit into mortgages. Quite frankly, if you believe rate volatility is going to be down, mortgages have become interesting, and credit spreads have gotten pretty tight, particularly U.S. investment grade has gotten pretty tight. So we've rotated out of that. We've bought a little bit of EM recently. I would say recently over the last 6 months. We haven't bought EM in a long time. If you believe the dollar is contained, EM becomes pretty interesting. And the yields, relative to high yield, the yields in EM are attractive. So we've cut a little bit of high yield. We've got a good amount of investment grade credit, and we've rotated. So today, I think our average rating is A-, which is pretty good. So it gives us a little bit of room to do some things like EM.
You said something that was interesting there, which is you don't have to go very far out the risk curve in order to get income now because yields are high. Yeah. If the Fed were to cut rates, does that make you more inclined to take more risk?
Yeah, I have to say, for two decades, part of why I'm so excited about where we are today, for 2 decades, it was like, I got to buy high yield at 3.5 and 4, and it doesn't feel natural. But now, if you have the risk-free rate, particularly in the front end here, gosh, I put a little bit of spread on it. Now I get what is ample yield with default rates that are not that elevated. You are seeing some bubbling defaults in a couple of places. So, I think the thing that we would do is, I know what we would do is if rates come down, I'm not a believer, and this is what blows you up. I'm not a believer is, gosh, I got to keep that yield, I got to get my risk up. You just have to absorb it and say, you know what, I'm going to run, I can't run 6.25 or so. I'm going to run 5 3/4 to 6. But what will happen is the cash rate will come down, and people say, gosh, you know what, cash is only getting me 2.5 to 3. And inflation, even if inflation's 3, it's still pretty good.
Okay. Very few people on Wall Street, though, are saying, you know what, I can just live with less income. It's okay. I won't stretch too far. I'll be disciplined, and maybe I'll just take less cash and I'll commit to the economy. At what point can you imagine that things start to get a bit excessive, especially given the fact that there is a lot of cash right now looking for a home?
So, by the way, it's a funny thing as you say that. We live in a competitive environment. We can't just sit back. I mean, it is a tough business, and we have competitors and people that are out there say, gosh, I can get you more yield. Listen, I think one of the things you have to do is you got to keep your volatility. As long as you always think about what's your yield per unit of volatility. Today, I think equities are still going up 15 to 20% from where they are over the next year. So I'm just trying to keep our volatility at a reasonable place. What is excessive? There's some things that are bubbling in the markets that are mostly in privates that are, gosh, I don't get any cash flow for 2 or 3 years. What's the multiple you put on that? Like, that stuff is hard. There are some really good business models. You say, I see it, and it's almost definitional. You see some parts of it where people have stretched, and in some of the credit markets where some of the levels get aggressive. Part of why we've rotated some of the investment grade. It doesn't do that much for us anymore at those spread levels. But I don't see, like, you saw before the financial crisis, excessive low covenant or easy covenants, high LTV financing. I don't see that yet today. Around the edges a little bit, but not really.
15 to 20% on stocks. Yeah. Another double-digit year.
Jonathan, I think we're living through history because what you asked about before, because productivity and ROE is so spectacular. And by the way, I don't think it's 500 stocks. I think it's, by the way, we heard a stat yesterday. If you take the S&P 1500, is this right that I heard it was 22% off the highs? I thought that number, Russ Costridge, I work with Doug, I thought that was extraordinary. If you take the highest ROE businesses, let's say it's 30 stocks, 50 stocks, tech, healthcare tech, some of the financials, they're doing really well. They throw off a lot of earnings. Their ROE is high, and they buy back huge amounts of stock. Small cap, don't really know. But there's enough stocks with enough market cap that I think will get you that sort of return.
Stay with market weight on the S&P 500?
No,
embrace
we're long.
The concentration?
We're long. We've reduced a little bit of beta. When equity volatility picks up, I have to bring my beta down a little bit, but I'm still running long. And, days like yesterday, single name, we get these earnings reports, and single name vol is high because, if companies don't hit these excessive numbers, they hit the stock.
Yeah.
So you can still do some things to protect some downside. And by the way, interest rates, if you believe the Fed is moving, albeit deliberately, interest rates actually act as a reasonable hedge again. So there's some correlation to rate that's allowed us to run a moderate long.
Stay with us. More Bloomberg surveillance coming up after this.
Here's the view of Sarah House of Wells Fargo, writing, the absence of broad-based layoffs suggests the jobs market is holding together, even if the risk of a more meaningful slowdown cannot be ruled out. Sarah joins us now for more. Sarah, welcome to the show. Just to pick up on those headlines from the Treasury Secretary, if we start seeing $2,000 tax rebates, if we see significant relief early next year, how would that change your outlook?
Yeah, so I think already we're looking for a pickup next year just because you have some pretty favorable tax policy coming out where consumers are going to get pretty big refunds come the early part of the year. And so if you add $2,000 rebate checks on top of that, I think you would get a meaningful pickup in spending through the first few months of the year that could help, I think, balance out, I think, more of the components of GDP that we're seeing, where maybe it's at least temporarily a broader based increase in overall consumption rather than one that's being driven more by your asset owning higher income households.
Sarah, we saw a taste of this, and I know it's not the same thing, but during the pandemic era checks that people got, and a lot of people attribute the inflation that we saw in the pandemic era to some of those particular checks. Do you think that there'll be a similar dynamic, or do you think these are too small and not regular enough to have that kind of transmission mechanism?
Well, I think there are a couple important differences there. So yes, if you're injecting cash directly into households, especially your lower income households, they're going to go and turn around and spend that. But there's other sides of this that are different. So you don't have the same degree of supply constraints. You don't have, I think, the labor supply issues that we had at that time, where it wasn't just the increase in demand that I think led to the pandemic era inflation, but it was some pretty unique supply factors. So I think overall, rebate checks, even the larger tax refunds that we're expecting, I think that's going to make it harder for inflation to continue to grind lower. But I don't think that it would be something that would necessarily respark a sustained pickup in inflation again. I think it would just more derail the path, or at least slow the path of disinflation that's set for the second half of next year.
Sarah, the implication here is faster growth and potentially an expanded fiscal deficit in order to finance a lot of the programs that are being proposed, likely will be proposed heading into the midterms, not just by one party, frankly, both parties talking about similar types of responses. How are you factoring that into your economic outlook at a time where there already have been some concerns raised about the U.S. fiscal trajectory?
Right. So I think, again, if we're talking about one-off checks, this is only a temporary boost. So this is not something that's going to be fundamentally sustaining the outlook for the consumer. And to the extent that it does increase the deficit, then you're going to be seeing some of that feedback into yields, which is also going to flow through to other things, so potentially mortgage rates. And so it's not a panacea for, I think, really reviving the sluggish pace of growth that we think we're hitting here in the fourth quarter, maybe in some of the early parts of the first quarter, given that there are going to be some feedback sides of this in terms of what happens with borrowing costs.
Sarah, what should anchor our view of the labour market right now? I think that's the question of the year for the labour market. Employment growth is super low, but the unemployment rate is also low as well. Do you think the employment growth maybe overstates the weakness, or does the unemployment rate overstate the strength?
Yeah, so I think the hiring rate, I think it does overstate the weakness, given that some of this is supply. But I think we can't chalk it all up to the immigration story, for example, or just the ongoing population aging, where we are seeing demand continue to weaken. So look at Indeed postings, look at the PMIs, whether it's the ISMs or the Fed, still showing employment in contraction territory. And so I think there still is a demand problem here. And I think even if that break-even rate is lower, that still portends something for what's happening with household income and therefore spending power. But when we step back and I think at that main point that we need to keep in mind, it is where we are in terms of that overall balance. That's what the Fed is looking at. And I think there we are seeing some softening, but not in a material or quick way. So it's just this gradual ongoing softening that's keeping the Fed on edge, but not definitive in terms of the labor market really being in trouble here.
Sarah, what is your best guess for the Federal Reserve on December 10th?
So we still have that they'll cut another 25 basis points. So obviously that's a close call where it doesn't look like we're going to get even the November data that we usually would have had with the shutdown ending. I think the CPI, we're not going to have that for November. It's going to be a close call of whether you get November employment. But I think the overall position of, look, we need to move closer to neutral. Inflation, yes, it's being temporarily held up by tariffs, but you're not seeing that spill over into services. Path there is still lower. I think that still supports the argument of moving towards neutral. And I think when you look at the voter composition too, that some of the more outspoken hawks are the people who have come out and said, look, I'm having trouble supporting another cut. They're not voters. So I think when push comes to shove, we'll get that additional 25 basis point cuts in December.
Stay with us. More Bloomberg surveillance coming up after this. Big question for all of us tracking the markets. When do we get the economic data? The National Economic Council Director Kevin Hassett had this to say in the last 24 hours. I've been told that some of the surveys were never actually completed, so we'll never, perhaps, even know what happened in that month. What does that tell you about the October data?
That we're not getting CPI. period, full stop. I mean, or if we do, it's going to be so muddy that people are going to really struggle to understand what exactly it looks like. We are going to get September jobs report. That probably will be number one, possibly early next week. After that, kind of a pot shot, whether it's retail sales, whether it's other peripheral data points that indicate inflation. But right now, it seems like we're kind of going to be in that fog for maybe forever when it comes to that 1 month period.
It's not going to be fun for the next few months. Jon Lieber of Eurasia Group joins us now for more. Jon, welcome to the programme. What's your understanding of the data we will get and won't get in the coming weeks?
Well, the BLS and the BEA are still shut down, so we don't know exactly what their plans are. I'd expect they'd probably announce something by the end of this week or maybe Monday of next week, a timeline for when they will get these reports out. Some of them, they can collect the data. November's looking dicey right now because this is the reference week for payrolls. They could always push that back a week and collect the data next week, and then they release the November data a week later in December. That's what they've done in previous shutdowns, but we really have no precedent for anything like what we've seen here in the 2018 shutdown. The government was partially funded, so data releases weren't disrupted. And in 2013, which is the closest analog, you had a 2-week delay, and then you had some delay in other some of these reports coming out. I do think it's right. We'll just never know some of the things from October. The employer survey, we probably can get some pieces of that from October, but the household survey, I think they probably just won't release anything, and we'll be flying blind on that month.
Jon, give us a reality check. I'm in New York. We cover financial markets. Obviously, there's a home bias. We think this is really, really important. Is it even on the radar of people down in Washington, D.C.?
No, this is not an issue that's come up, I think, in any of the shutdown discussions. It's a distraction. This is about Democrats wanting to rein in the Trump administration. It's about healthcare costs. It's about a whole bunch of other things except data. I mean, these are would be in Washington would be considered extremely wonky issues, and nobody on Capitol Hill is wonking out about this stuff.
Yeah, but there is a larger takeaway here, John. And I was looking at the history of government shutdowns. There have been 6 since 1990. They're getting progressively longer. They were 2 to 3 days under Ronald Reagan and George W. Bush. Under President Clinton, it was as much as 21 days. Under President Obama, 16 days. Under President Trump, 1.0, 35 days. And now here we are at 42 plus days. I'm just wondering what this means about Congress's ability to get anything done, and whether January 30th is the next D-Day where we're going to get another government shutdown.
Yeah, I mean, I think you hit the nail on the head here. The federal budget process is fundamentally broken. It's been broken for probably a decade now. And as it kind of creaks and cracks and Washington becomes more partisan and things become harder to do, I think the brokenness of the federal budget system becomes more obvious and starts having real world consequences. Congress hasn't completed an appropriation cycle on time in years. The idea of even doing a budget for reasons other than doing a reconciliation bill is basically laughable. And I think what you're going to see is increased likelihood of shutdowns. Now, in the past, what we've seen is that nobody really wins from a shutdown. Members come out of that saying, gosh, I don't want to do that again. I'm not sure that's what you're going to see this time around, given how long everything functioned just fine under the shutdown government. I mean, a huge portion of federal workers were considered essential, meaning they could do their jobs but not get paid. And it wasn't until flight delays really started kicking in and you had this issue with SNAP benefits that people started to really feel the real world pain. But I think that one of the lessons of this shutdown is that a week or two or longer of shutting down the government really isn't that big of a deal. President Trump can fly around the globe making peace deals, tearing down the East Wing, and it doesn't affect people's lives until you get much deeper into the shutdown.
Yeah, but John, to John's point earlier, when he was talking about the fact that we may not get this data ever in terms of data that was not collected during the reference period, Greg Dako over at EY Parthenon said that about 20% of the economic hit from the government shutdown probably will be permanent, just simply because there is sort of this lost economic activity. I'm just wondering, does this change the landscape for investors, for corporations trying to maneuver in a world that is affected by a government shutdown, even if most people don't feel it?
I think that if you're thinking about the future and thinking about possibilities of what the future is going to look like, you've got to have a much wider range of outcomes on your radar and prepare for those outcomes. You could have an even longer government shutdown in January. There could be no government shutdown in January. You could have the Democrats take back the House next year, and then you get an even longer shutdown coming in 2027. So I think there's a lot of different possibilities here. You can't rule anything out. And I think that the fact is that the policymakers just aren't going to respond until their constituents are feeling feeling pain. And right now, and it's possible that this government shutdown, everyone walks out of this and says, boy, that was more painful than we thought. And to your point, the data is the economic pain is permanent, but I don't get the sense that's happening right now, but we'll see how people feel in a few weeks.
John, things are changing down in Washington. And can we just wrap things up by leaning on your experience? You know the Capitol well. Nancy Pelosi is stepping aside. She's retiring. Senator Schumer is under immense pressure. You worked alongside the former leader, Mitch McConnell, longtime leader of the Republican Party. What's left of Washington, D.C. that you knew so well?
Very little. I think you look at the committees on Capitol Hill, they don't do much anymore. They're not producing legislation. Lawmakers are no longer kind of growing. The senior lawmakers that are going to be running the show in the next 5 to 10 years aren't ones that grew up in this era of bipartisan compromise where they came to Washington to do legislation and get bills done. They're people that came up in an age of Donald Trump and social media. And I think that creates a different set of incentives for lawmakers. It makes lawmaking harder. Congress has abdicated a lot of its responsibilities, and the public doesn't take it very seriously. So I think on Capitol Hill, at least, you're going to get a much weaker generation of leaders, and no disrespect to the people who are there now. This is just a broader trend. And I think it means that Congress takes itself out of the governing game and puts itself into a full-time campaign mode that's going to define more and more of the noise and policymaking you're hearing out of Washington.
Stay with us. More Bloomberg surveillance coming up after this. Stocks rising as investors await the end of the government shutdown and the release of a lot of delayed data. Matt Miskin of John Hancock writing, bad news is bad news, especially when it comes to the jobs market and a Fed being hawkish. Regardless, markets have a trade the headlines mentality that is far from fundamental. Matt joins us now for more. Matt, that last line, what did you mean by that?
Well, I was just talking about you guys mentioning vibes here. It's a vibe market, and it's all driven from sentiment for the most part. And really what we're seeing is this jaws kind of presenting itself from the weaker economic data and the markets continuing to advance. At the end of the day, sentiment is a very powerful short-term market force. And we are seeing momentum investors around the world really allocate towards stocks because they're rallying. Even in these mornings now, you're not even getting necessarily a narrative of why things are up other than it was up yesterday. And so we really see it even at the beginning of the week on Sundays. It used to be Sunday Fun Day, and now it's Sundays are a time where markets open, and there's usually some sort of headline that hits the markets first thing. So Monday morning, we open stronger. And that sets the vibe or the tone for the week. In our view, this is a time where you want to think about more defensive or conservative options for portfolios and not to really overweight risk and over your skis in terms of risk at these kind of levels. But it's been a very strong year for markets, and we'll take it.
So, Matt, let's unpack some of this, and let's start with the data, the jobs data. How relevant is the jobs data to a market that's been driven by technology that is arguably holding back jobs data?
Yeah, John, this is the circular feedback loop that everyone's really highlighting is, it doesn't matter about the jobs because these companies are running more efficient. The AI is helping them increase earnings. And as long as those earnings are going up, that helps the stock market. Makes sense, right? Well, the missing linchpin of this argument is that you need the U.S. consumer to spend. There is no more powerful economic force globally than the U.S. consumer. And if the U.S. consumer doesn't have a job, they can't spend. And that's where we struggle to find this feedback loop and why we think that the weaker jobs data really is going to present weaker consumer spending. You're already having weak consumer confidence. Now, to us, this means the Fed will end up cutting more than the market thinks. Right now, the Fed is actually, in our view, overcompensating a bit because they think they're going to be more dovish into 2026. So they're being a bit more hawkish now. It is really fascinating to see stocks really kind of just float through that with minimal impact. But in our view, the weaker jobs data is very material for this economy and markets in time.
Matt, why do you reject the argument that in the beginning of next year, we're going to get tax rebates and all sorts of other stimulative measures that will really cause a boost to consumption?
Yeah, at the end of the day, the jobs market, like I said, is so important. And when you look at these, whether it's the Challenger layoff announcements, so the ADP data, and you look at prior periods when it rose or when it caused the initial jobless claims to rise or the unemployment rates to rise, it's usually about a month and a half lag time between the initial layoff announcements and when it hits the data. And really, if you kind of time that out here, it's the beginning of 2026 when initial jobless claims start to rise, the unemployment rate starts to rise. And you think about this, the unemployment rate, the last data point we had was 4.3% in August. At 5%, usually that's a recession. And we're already likely ticking up. I mean, yesterday, Goldman Sachs said that more likely than not, we had a 50,000 job decline here in October. If that was actually the release of that national non-farm payroll report, in our view, that would have been a shock to the system. And so that's what I struggle with is if you're telling me that there's all these, kind of good things coming in the pipeline, the other side of this is we're still going to be catching up on weaker data that really hasn't been released here in the last month or so.
Matt, that R word was kind of jarring for me because I haven't heard it in so long, and no one's talking about recession. I mean, that seems to be nowhere on any of the earnings calls from corporate executives across the spectrum. We're not hearing mentions of an economic slowdown or anything like that. It really has come in at the slowest pace in terms of mentions of that going back to 2007. What does conservative mean in terms of investing? Does it mean just hide out in the 10-year, or does it mean actually high value companies that are also facing pretty elevated valuations in addition to, yes, very steady cash streams?
Yeah, so at the end of the day, there are companies that are growing earnings. We do like higher quality companies. Quality has not been in favor this year. It's been more of a low quality rally. But in our view, we would position higher quality in the equity space. We are looking at infrastructure related equities. Across Europe right now, you're seeing Europe rally. Some of that is infrastructure related utility type businesses that are throwing off dividends. They've got great earnings. So infrastructure related equities is one way to do it. We are looking at in the bond market, like you said, I mean, we're still getting nearly a 5% yield here. And yields have come down this year. But if the 10-year did drop below 4%, which is support, we think there's more return potential there. So there's still a lot of income and return potential out of the bond market. In our view, though, on the equity side, we're more neutral on U.S. large cap. We're overweight mid cap to get more diversified exposure, better valuations, and we're underweight small cap because, frankly, there's just so much non-profitable businesses there. So it's a modestly below in beta.
Talk about vibes. The ultimate vibes trade of the year is Europe, dressing up 1% GDP as if it's the next best big thing. Matt, you really want to stand European equities into 26?
So we would look to trim into strength here. And this year is probably years worth of returns. If you look back over time, I mean, whether it's Italy or Spain, I mean, Spanish stocks, who would have thought? I mean, the economy is doing great. So congratulations on that front. But really, the stock market there is trading almost like it's another entity. And a lot of these, markets are trading almost like they're just ticker symbols versus a company or a country. And we want to be mindful of that we're not really just day traders here. We're not just trading these for momentum. And we want to look at the underlying fundamentals. But yeah, Europe is on fire this year. European financials breaking out here. And again, that is a sentiment indicator. There's positive vibes globally right now.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.